had discussed something to do in line with the markets. First, we had to define what markets is all about. Then we agreed that it's where you buy and you sell commodities, but in this context of investment and portfolio management, it's just the buying and selling of securities. And we had to discuss examples of those securities, and they took us to this context of types of markets, where we have to look at two types of markets, and these are where we discussed about these are capital market and the money markets, and we had to look at characteristics of capital markets and the money markets. But one of the most important characteristics that we actually saw was that in capital market, it is where you have got two divisions or forms, secondary and primary, unlike the money markets. Then we had to look at what is involved in the secondary and what is involved in the primary markets. So we said in secondary is where you are involving an agent, and this agent is what we call a middleman. And in this context of capital markets, we agree that that is the Mars Stock Exchange, which are known as the brokers. Because about a broker is someone responsible in selling shares. Because we are looking at the stocks here, securities in form of stocks, bonds, derivatives. These are the securities that we are talking about. Today, we want to look at the efficiency of the market. I want to answer this question that if we say that this market is efficient, what do we mean? One. Secondly, who introduced these efficient markets or the market to be efficient? Who discovered or who got the idea that when you have got this criteria, it means that the markets are efficient? And again, we look at some characteristics of efficient markets. Those are the areas that we'll be looking at today. Now, let's start our discussions today by looking at, by answering this question on what is market efficiency. Now, let's define this market efficiency. So, yes. Right. Right. Oh, we want to have to market efficiency, right? But now there are other contexts that I have to add on top of the market efficiency. There are other contexts that we have to look into that. What certain things then you have to be. Now, if you look at this market efficiency, what comes to you when you talk about market efficiency? What do you?
I think things get better market.
Huh?
When you're doing business, there's supposed to be stability.
Stability in form of what?
Information prices.
The information prices of commodities, right? Now let's just look at this as the definition also, and who invented it. So when we're looking at this market efficiency, we are referring to the degree, just a degree. The market prices reflect all the information available. Reflect all available and relevant information. Available and relevant information. So, market efficiency, we are looking at it as a degree in which market prices reflect all available and relevant information that has to be available. In other words, if markets are efficient, it means that they must be incorporated. The price for the securities, they have to be incorporated in that information. That means that the market are efficiency. There should be the incorporation of the information and information of the price of the securities. That means that the market is efficient. Say that the market is efficient. Then all information has mentioned about prices. Prices should be incorporated. Should be incorporated. And no way to beat the market. Since there are no undercharging or overcharging. Right, when we are looking at that this market is efficient, we are talking about that all the information about the prices of what? Prices of securities should be incorporated and nowhere to beat the market since there are no overcharging or there is no undercharging. What it means there, the market that is efficient, the prices shouldn't be overcharged or shouldn't be undercharged. The prices, they have to be incorporated in the information that is given. What they are trying to mean is, if for instance, they are selling a company, assuming that Airtel is being sold through shares. So the information about the prices of the shares, they must be incorporated or they must be known publicly. And we call that is efficient market. Hence, when those are being done like that, there is no overcharging or there is no undercharging. That is efficient. The opposite of market efficient is now inefficient. Where inefficiency now is where now everyone has got the right to do according to his or her will. That is inefficient. For example, the black markets. Where in black markets, I can charge based on my opinion. Someone can charge based on his or her opinion. So you say, I run, can you come? I have a run, I'm selling it this, I'm selling it this. That is in efficient market. But where there is efficient market, it means all the prices they are the same. No one is overcharging and no one is undercharging. If, for example, they are selling a share at 2 kwacha per share, it means that information is known all everywhere that they are selling shares. If it bonds, whether securities, whether derivatives. So the prices of this have to be equal, they have to be known by information. Therefore, the most important way there is, the reason that is making this to be efficient is the overcharging and the undercharging. Because where there is no overcharging and there is no undercharging, it means that things they are known. Because the aim behind for any market is to make profit. So people they sell with the aim or they do overcharge just because what they want is they want to make more profit. So this is the definition of the efficiency of the market. Now, who adopted this efficiency of the market? Long time, around 1970, there was an economist by the name of Eugene Fama. Eugene Fama was an economist who discovered the market efficiency. And he called this as efficient market hypothesis. That was Eugene Fama in 1970. He was an economist. And you know, this guy, Eugene Fama, he tested this based on scientific method. That's why he's calling it as a hypothesis. He used several scientific methods to come up with his decision to show that this market A is efficient or this market B is efficient. That is Eugene Fama. And I like him, I like this guy because he is the one who again came up with this what is called the Fama-French model that you are going to see here in due course. Not now, but you are going to see the Fama-French model. And this model is of, it's more or less like an economic model where they are talking about risks and return. So they compared risks and return based on the securities. So that was the very same guy who came up with this theory. Now let's just put it, let's write down here. The definitions. The market was discovered in 1970 by an economist known as Eugene Fama. He called his theory as efficient market hypothesis. Efficiency market hypothesis. This is efficiency FH based on scientific investigation. Did that and used that based on scientific investigation. In this theory, he actually emphasized that it is not possible for an investor to outperform the market. That's the major element that this guy came up with. In his the efficient market hypothesis, EMH, what he stated that it is not possible for an investor to outperform the market. So according to the theory, the emphasis is that it is not possible for an investor to outperform the market. Right. What is trying to mean here, this guy? He is saying it is very difficult for someone who is being an investor, who we call that this guy is an investor, to outperform the market. If you are an investor, you shouldn't at least take the market to be as if it's yours. That's why there should be, there is that language where this guy is saying there must be no overcharging or there shouldn't be no undercharging. So this issue of no overcharging and undercharging is the one that is now coming here. That no investor should beat up the market. Shouldn't at least charge more than exorbitantly. That's what he's trying to mean. So he says, in such a situation, he is trying to stabilize that all in using this efficient market, everything has to be equal. There must be, the charges, they have to be very, very equal. No one should overcharge, or no one should undercharge. So everyone should at least charge equally. Whether you are in Kitipa, whether you are in Msanje, so the charging has to be equal, it has to be uniform. Whatever idea you have about the shares, that idea should be the idea that you are taking it, that everything is equally distributed. In that situation, the market is efficient. Remember here, so the bottom line for this market to be efficient, if for instance, I am asking you, can you explain, can you describe with your own words, say that the market is efficient? Should at least incorporate who discovered this theory of the efficiency of the market. And what is this theory all about? And again, you have to at least incorporate that there must be market prices available. Not ordinary price, because the moment you say there are prices, I'll try to question that what type of prices are these. So I wanted you to mention that market prices of securities, they are available and relevant information has to be spread across through the public. In that situation, that market is efficient. And again, another stress that I want to be, that I will need from you when you're answering this, still you have to remember that investors should not beat up the market. Because there are other times you find someone, this investor is the one who would like to make money, who would like to have a profit at the end. So whatever is charging, he may charge exorbitantly, then that would be a disadvantage. That's why this market, the efficiency market, this guy, Eugene Farmer, is coming in. He says, no, markets, I think no investor should outperform the market. That's what Eugene Farmer discovered. So you can see that this issue of market efficiency seems to at least work very, very well based on Farmer. So according to this one, it's not only, we are not only talking this about the efficiency of the market in the context of Malawi only, but again we have to talk about the efficiency of the market in the context of United States or even in UK. The markets there, they have to be efficient. No one should beat up the market. Everyone should be equal. The investors has to be equal. That is the efficiency of the market. Now again, from there is where now we are looking at this issue. Of course, here everything concerning the efficiency of the market. What has to be in your head? What we are looking at here is financial behavior, because sometimes you have everything that we are talking here about the efficiency of the market is financial behavior of securities. Financial behavior of the securities. That's why we are looking at it. Now let's look at what are the forms of efficiency of the market based on the Eugene Farmer. What are the forms that he discovered or that he came up with based on Eugene Farmer? Now Eugene Farmer came up with the three major efficient forms. He stated three major efficient forms. Now let's look at these efficient forms. forms of let's look at these forms of efficient market hypothesis. Now, before we look at these forms of efficient market hypothesis, as I actually said that this market hypothesis based on a Gini farmer is taking them from what is called the capital markets. It's not taking them from the money markets. It's centered at capital markets. Why do you think that is aiming at the capital markets? Is centered on capital markets. Why do you think he's aiming at capital markets and not money markets? In other words, Eugene Farmer discovered much about this through the capital markets. Why do you think so? Yeah. Why do you think that this man, this economist, is centered his discussion on capital markets and not money markets? Right. It is in capital markets where we have two divisions. You remember I actually introduced you at first that in capital markets we have got a primary source and we have got secondary what? Source. Especially in this secondary source. When we talk about primary, we are looking at over the counter or over the counter, OTC. Or when we talk about over the counter, we are saying that you receive and you pay directly through the cash. You call this one at the counter. You call bank there, right? That's over the counter. You deposit directly. That's over the counter. Or this over the counter. You are directly meeting with those guys. When you have money, assuming that you have got 20 million in water, you have one list blessed, you have blessed with 20 million in water, and you want to take this money and then to deposit them through capital markets, you go directly on the counter and you agree terms and conditions. How much are you going to charge me as interest per month, and how will I be soliciting my interest? They will tell you every month end, come and get your interest. That is over the counter, right? Over the counter. It means over the counter is 1-to-1, right? 1-to-1 is an over the counter. But now, within this, I was asking you that why is this efficient market hypothesis in connection with the capital market? It is in connection with the capital market simply because, one, in capital market is where you have one capital market is associated with the stock exchange, my brokers. Capital market is where you have one stock exchange. If you will explain that in terms of that one, I think you know. Because there is no, capital markets are not associated with the stock exchange, they are not associated with money markets. They are associated with the capital markets. Because it is these guys, the stock exchange or the brokers, that are responsible in selling the shares. If you want to have shares, if I want to buy shares, if one of the companies, whether Blantyre Waterboard or whether Waterboard or Airtel, they are selling Airtel. If I want to buy Airtel, I have to meet these guys, the brokers, the Malawi Stock Exchange. Where will I get these guys? I will get them through the what? The capital markets. The capital markets, they will tell me that this is the one you want shares. No, this company, they are saying the following company, they are on the list. So you can choose which company you want. Or I want this company, all right? So they are saying shares, each share. Because the shares do differ. Does not mean that the shares, they sell shares the same. So the sales differ from one company to another. Or they are selling shares at 5% per share. So how many shares do you want to buy? Oh, I need this. Oh, I need this. So they will do like that. Oh, I want this, and my son this. You can buy the shares for the son, for the daughter, and whichever. Provided what you are doing, you should know that at least you are investing. Because the underlying principle there, it is investing. By definition, who is this an investor? Investor is a guy who invests, he invests or he deposits or he keeps money with aiming at having a return at the end. A return is the profit. And at the same time, although he's having a return, this investor is again he must experience what is called risks. You cannot invest whatever you are doing in business. There are two issues: return and what? Risks. Does not mean you may buy shares. At the end of the year, you will discover that the dividends you are given these dividends, because the dividend is what you are being shared. What you are sharing is the dividend. The company's profit, their dividends, and these dividends will be shared to individuals, to investors. Then you'll be shocked. You'll be totally shocked. Even you can be shocked that you bought shares worth about maybe over 500,000. You bought shares 500,000. You'll be shocked. The dividend you will get at the end of the year, which can be even less than even 50,000. You can be shocked. But I bought a lot of shares. Why is it that I'm getting this? It's where now you think of hedging. And this issue now of hedging comes in. You are selling it to someone. It's where you go back to the brokers and you say, I want to sell my shares. It is the very same brokers that will assist you in selling the shares. They will sell the shares. And the selling of the shares, they will go as fast as possible, because a lot of people would like to have the shares. So it is more or less like they will sell that at a very fast rate. That is what we are looking at as the efficiency. That's why I'm saying I'm trying to explain this, because I know this area is very, very important on the efficiency of the market. Now, with Jim Farmer, he actually came up with these three forms of efficiency of the market. One of the efficiency market is the weak. So he actually came up with the weak, semi-strong, and came up with the strong. So there are three forms. One, weak. Two, semi-strong. And three, strong. Is bringing three issues here. This guy is bringing three issues. In other words, he's having a three hypothesis. Is bringing in three issues, and these issues they are weak, semi-strong, and strong. And we'll look at each and every form with keen interest and see what is making one form different from the other. That is what we will look at. Right, you may ask, before we look at the first, which is the weak, you may ask, why is it that you have to take much of your time learning about something that someone did long time ago in 1970? What is the significance for you learning this efficiency of the market? The reason is very simple. The reason seems to be very simple. Is the fact that you are doing your degree. One time you may be chanced. You can have this chance of being given a position as a portfolio managers. A portfolio manager is a manager who is responsible to advise customers on these assets, on some of these securities. Should be able to advise. At when the fact that you have come to buy these shares, any time from now, things can be worse. Or looking at the way it has been doing, why can't you buy A, B, C, D? It's there to give advice. It's to give advice. So those advice are being connected in connection with the shares. You are buying this, but why can't you do this? Those are what I call portfolio managers. In the National Bank of Malawi, we have my portfolio managers. In these other markets, like Reserve Bank of Malawi, we have portfolio managers. So you may be lucky to be a portfolio manager. I hope you should be able to explain these securities. I don't want you to mess up that you know nothing about this. So that's why we are looking at one of these issues, and this is what is called the weak form of hypothesis. Now we are coming to the weak form. Yeah, I know. Right, let's just look at this week 4. I still remember that again last time we had to talk about this one, but I will not talk about it fully to at least this some because they were trying to expound, we are trying to put other information that I think you have to defer because sometimes the question can come and I like this issue and very soon you are writing your mid-semester. But this one, I think I mark it with very key, showing that you know. I don't want someone just to write just one sentence and you say you have written and you claim 100 marks. That's why I'm now trying to read in this information. Right. Now let's go to the weak form of EMH, weak form of efficient market hypothesis. Weak form of efficient market hypothesis. Now, this weak form of efficient market hypothesis, it assumes that the current stock prices. Now, let's look at what are these current stock prices. One, what has to come in your head is the current stock prices. They have to reflect all the securities market information, including historical sequence of that security. So this historical sequence is more or less like one. We are looking at prices. We are looking at the return or rate of return. We are looking at the block trades, transactions, everything, something like do that. That's what we have to look at. We are looking at that in form of that. Of which at that time I did not even expand it to some. I will not to do where I want to do now. Now we are looking at this week. It is assuming that all current stock prices. Now let's look at what are these current stock prices. Number one, we are looking at week. So week is explaining about all currency stock prices. The current stock prices. Something that is current. Something that is current. What comes to your head? The current stock price. What is it? Huh? The current stock prices, the rate, all right? So, now something is, that rates what current, what is current, something that is current. What comes to your head when say something is current? The latest. So the latest rates, they have to reflect all the information. In other words, that the rate that is there should not depend on the historical sequence. So the rate, in other words, the current stock prices, you know what the stocks are? Do you know what is stock? A stock. What is the stock? Shares. They are sometimes they are referred to as they are shares, right? The stock. So the current stock prices, the current these share prices, they have to reflect all the current market information. So all the current market information, which these are, they have to look into what are called historical. They should not they are incorporated in historical sequence. Historical sequence. Look at historical sequence of the price, rate of the rate of return, RR, rate of return, which is known as RR, the price, rate of return, trading volume data, trading volume data, everything has to be inclusive in that. In other words, something that is weak, you depend on in the past. For example, because last year, I mean, it was this year when we had this flood, this flood, Friday, cycle Friday we had this year. So you may, if you are thinking that you're being weak, something that you are weak, the fact that you are in that situation, you may think that because this year we had a free day, the next year again we will have what? freely. You can tell those who are from the mountain, please go away from the mountain. If we had this race and next year again we will have the very same race. You are looking at that based on the what? Based on the historical sequence. Right? Therefore, there are a lot of people, they do buy shares because last year someone bought those shares and they had to make profit out of it. Last year the rate was good. Last year the volume of what people bought, it was very, very okay. And why can't I do this year? Why can't I buy a lot of them? Right? It is as good as I remember. I remember just very recently, right? I saw someone, he actually said, no, I left my eggs at the hatchery. He left about 20 eggs in the incubator, right? I mean somewhere, private incubator. And by chance, 19 were hatched. Only one got unhatched. It was just like it was a rotten egg. So 19 of them he collected. To him, it was a very great achievement, and he was happy about it. Very, very happy that, oh, I left 20 eggs, 19, they are fine, right? And then I actually said, if this guy did the same, why can't I do it? Then myself, I went, I collected, I bought eggs, fertilized eggs, about 60. I said, let me put them in the incubator, and then the private incubator. I put the eggs in the incubator. You know, the result that came is only 10. I only got 10 out of the 60 eggs. All 50 eggs were bad. You can see, I did that based on the past what? History of that someone, it was someone got at least or about 100% results. So I thought that by taking this, though there were many, I will have the same results. Not knowing that it was now a reverse. It's exactly that is what is weak. Those guys who plant tobacco, if you remember, there was a certain time a lot of people had to plant tobacco because it was tobacco had a lot of money. It had a lot of money. And people could even live cultivating maize, and they were growing for what? Tobacco. At the end, what came, after some time, that year, a lot of people got money to the extent that many people marry several wives because of tobacco money. But you know, they came another year, so almost 3/4 of people in Malawi, they switched on to tobacco growing. That year the sales were bad. They discovered that no, there were a lot of losses. Then people said, we have to surrender, we will not grow tobacco. Here we are now, tobacco here in Malawi, very rare that people are growing. So that issue, that is, you are based in those issues as weak now, that is what you give with Eugene farmers. I can say that if you are thinking on those lines, that because last year the rate was this, then the other year the rate was this, why can't I do it? That is what is called the weak form of efficiency hypothesis. Clear?
Yeah.
We should not think on those lines. What we have to think of, we shouldn't be like that. Therefore, those are just the assumptions that the current market price reflects all the past. So it's looking at that. Therefore, we should not compare the future rates. We shouldn't compare the future rates to the past rates. Let's avoid that. So we have to depend on the rate that is now. That's what Eugene Farmer is saying. Then he actually said, okay, if people have been doing something like that, therefore, to you as managers, when you be a manager or a portfolio manager somewhere, maybe you'll be blessed to be a manager at the Malawi Stock Exchange. For you, don't advise your customer that they should depend on the past. first the historical seekers. Tell them that whatever they are saying, that's why when you are selling them, that any time things can change down, or you can make profit. But it's more or less like it's a game of gambling. It's a gambling game. So it's either a head or a tail issue here. Now, the second form of this efficiency market hypothesis is the semi-efficient market hypothesis, semi-strong. Something that is semi-strong. What comes to your head when you talk about something which is semi-strong? What comes to your head when you talk about semi-strong? Semi-strong? Something that is semi. What do you mean? What do you think? Semi. Huh? Semi is half, right? It's half strong. In other words, when we look at semi-strong, are we deserting weak? Are we deserting weak? No. In semi-strong, weak is there. You have to take note of that one. In a semi-strong, weak is there. In other words, this guy who is thinking about the historical background is weak, right? And he's taking that information again in semi-strong. Because in semi-strong, there is the same weak. But only that what this guy is adding is just relying on the public information. So, what is happening in semi-strong? Semi-strong, it assesses or it assumes that the security adjusts prices rapidly due to the release of all public information. That is what is doing. Semi-strong, apart from the weak strong which is inside that, in the semi-strong, again, in semi-strong, the guy assumed that security prices, they adjust rapidly. They do adjust rapidly due to the public information that is being released, and that is all the public information. In other words, the current security prices reflect all public information. It reflects all public information. Right. Public information. Something that is public information. There are other information which are out there. People can depend on, they can rely on public information. Those information that even they can be advertised publicly. Under the context of investment and this investment and portfolio management, we are looking at this public information. It includes all non-market information. Yes. What is it all about? We are saying that there's a strong, there's weak inside. The information about historical is there. 1. 2. It is strong. There are what is called public information. In other words, it's public information that is incorporated. Then what I'm saying is, let me give you an example of public information. That's where I'm now going. I'm saying that it is strong. Apart from weak is there, and again, people's mind is only historical. They are comparing historical background and the future, right? That is the weak, right? And again, there is what is called public information, which is available. Then I'm saying, what is this public information? That's how I'm defining it to be as non-market information. Right? What about this public information being non-market information? It's non-market. Something that is non-market information. It's not a market information, right? In non-market information, these are just earnings and dividend announcements. Now, public something to do public. What do you think is public? Something which people should what? Should know. Right? So an example of this market information is one, we are looking at it as it is dividend announcements. My earnings and dividend announcements. Examples of market information. My earnings, we have got earnings and dividends information. A good example, right? Assume the Malay Stock Exchange, there is an information, public, newspaper, or newspaper is already, they are announcing that dividends were this year. My earnings, people, this company was sold, they do announce this. So people, because of that public information, people will say, I will join, I will buy shares for that, my newspaper, dividends is like month. Is it based on information from the what? From the public, which is announced to public. That's what is called public information. Right?
Yeah.
And that is referred to as market information. Because there is nothing, the public it is not to do with the market information. So another example of, apart from announcements, price and dividend announcements, who will announce this? Radios will announce. Who will announce this? Newspapers will announce. Right? People will announce. TVs will announce. That is what is called public information. Because they want it, they become tested. You say, then I will buy out of the shares because public, I have held that this they are making profit. That's what's called public information. Right? I don't know whether I'm making sense. Something to the public, what do you mean? It's for everyone. Newspaper is for everyone. That is very strong. And apart from that, sometimes people they depend on price to earnings. Speed that way. Price to earnings. Price to earnings is something which is called P to E ratios. If you did the accounting, we have what is called price to earnings ratios. Right? The price and what you have the ratios. If you calculate publicly, you can come up with the, accounting, you guys. Right? If you ask what is price and earnings ratio, they will tell you the accounts people what these are all about. But these are for the public. Not only the P to E ratios. Sometimes you have what I call dividend use, D/P ratios, dividend use. These are examples of non-markets. Non-markets, dividend ratios, dividend. We have what they are called dividend yields. Dividend yields, which is sometimes known as D/P ratios. Stroke is a ratio. What about like 1/2? It's the same as 1/2. So 1/2 means 1/2 is a ratio. You know that, right? It's a ratio. 1/2. The same as half is a ratio. 1 to 2. So this dividend yield is DWP, something like that. What the dividend yield, what it means is you have shares, the company, the profits that the company has made at the end of that year, they want to divide it to people, right? You might hear it from the radios, whichever, that this company was sold, has been sold, and this year it had approached this amount. That is what's called, you have the dividend use ratios. All those, we have got sometimes the price book value. Price book value, which is sometimes known as P/BV ratios. You read about this in accounts. You learn them. P/BV. Now this is price book or book values ratio. These are the various ratios. So the fact that you may hear from whichever newspapers about these ratios, that information is public information, and that is what is called semi-strong. It's not strong. It's not strong. So you can see that we should not only think of this one. Political news. Political news and another example of say strong. Political news. You know, at the podium, you know what the podium is, eh? You know what podium sign. You find that someone preaches there, right? When you do this, you do this, you do this, right? You think those are those true issues. You buy fertilizer and this one. Are those true issues? Those are just political news. That's saying what? Saying strong. They can be an element of truth, but they can be an element of false. That's why I call it saying strong. There is half element of truth and element of false is there. That's saying strong. Political news, economical news, something to do with economy. When we get to this, economy will go back to, we will take this to be a second heading. Those are called political news, right? Can someone take us this issue as being this is a needed or this is another second Jerusalem? It's not something like that. Those are just political news. And those ones, we call those are public, they are called public news. So say strong, if you depend on those issues, then that becomes strong. That is what this guy, Eugene Fama, what actually said. He discouraged people from just zoom over Liverpool, right? Whatever you hear, he said, you guys should not depend on what my hearsay. Because sometimes these hearsays can be false. Sometimes this historical sequence, things can change. No, there are other conditions that can change. You should only depend on that one. Then he says, what if that is the issue? Why can't we go to strong? So now he's now coming up with this issue about strong. Now what is happening to this strong? Something that is strong, unshakable, you can't shake it. Something that is very rigid. If something like this wall is very strong, you can't see the other side. Right? So what is happening with this strong? So in strong is again talking about my stock prices. Here what is there, when I ask you this question, don't miss this issue on stock prices. Stock prices. What we are talking about is whatever we are talking about the efficiency of the market is about the stock. Shares. Don't give me an example of how the examples. We talk about the stocks. So, and for the stocks, what are these stocks? Stocks are what? Shares. But share prices, which are known as security. That's why the definition of a market, when you tell me, if I ask you, define a market, and you say a market is a place where people sell commodities. In this context, it's not like that. It's totally zero. When I ask you, define a market, I will need from you to tell me that it is where securities are being bought. And you can recite examples of securities. They are the bonds, they are the derivatives, You know what derivatives are? We discussed about money derivatives, eh? Right? And examples of derivatives. We discussed about all that, right? Now, when you are looking at that, then you are looking at this issue on strong. Something to do with strong market hypothesis based on Eugene Fama is again looking at the stock prices. They are now, these stock prices, they are really reflected by one, historical sequence should be there, two, public information should be there, three, private information should be there. So there must be three what? Information. In strong, there must be three groups of information to be there. One, historical sequence should be there. Two, public information should be there. Three, private information should be there. Then we'll define what is this private information. Because we have seen public information. We have seen historical sequence. Right? Then what is this private information? I mean the private information. Now, this guy, when he's looking at this, he's saying, again, the fact that you are looking at the stock prices, they must reflect both the public and the private information. In other words, both public and private sources, they have to be there. What is trying to say? The meaning now. Get this meaning. This means that no group of investors, right? This means that no group of investors has a monopolistic access to information relevant to the prices. What does that mean? This information, they are saying that the fact that this is very strong, no group of investors has monopolistic access to information relevant to the information of the prices. Someone, when we are looking at that, it's no group of investors. There should be no investor who should be monopolist, who should, something that is monopoly, what do you think? Monopoly, what is it? No group of investors should have monopolistic access to information. There should be no one who's trying to get up now just because it's more or less like you see, it's more or less like should not be greedy. Assuming my shares, these shares are being sold, they are saying, what someone that sell shares. You discover that those who have good money, one would have just said, go be available, you grow my shares that company and say, right? But it's not like that. They are given limited. You shouldn't exceed this. That's my shares, yeah? We should not exceed. They are given, right? Even the president can go back. Even someone who is there, even with the 20 quarter, you can go buy a share. You can buy shares, right? So no one should not. You shouldn't. There is no monopolistic. They are being sold based on someone's working. The ministers would have just gone there. I was thinking the president would have just said, but it is something which is very strong, simply because there must be that information for the public information to be there, private information to be there, and so that you should not be, there is no one who is monopolistic. All the information, it should be just there. Everyone, no one should be greedy about buying that. Therefore, this indicates that above average risk-adjusted rate of return should be there for that. Hence, semi-strong, this is strong. It's there, it has to do with it has to do with the strong, it has to do with what is known as the perfect market. In other words, the way the strong market is referred to as is a perfect market, where information has to be given both from public, private, or not private. This private issue, people have to be privately told about the shares. Publicly, they have to be known, and even the sequence, they have to be known. In other words, you have to access both using public or privately. That is what is called strong form of efficient market. What you have to take from there, the most important thing, what you have to take from this is that you are looking at new public information is coming because of both public and private. So new information is coming because of public and private entities. Where now the market is said to be perfect market. Perfect market in which all information is cost-free and available to everyone at the same time. Well, this is very, very important. We are looking at that the market is perfect. Why do you think that the market is perfect? Because everyone, the information, all the information is cost-free. If they are talking about the shares that they are selling company by shares, do they sell that? It's cost-free. Everyone is able to what? Is able to listen. That is the perfect what? Market. So all the information, they are cost-free and available to everyone, whether poor, whether rich, whether whosoever, everyone at the same time. That is the perfect market. That is perfect market. That is efficiency of the market. I think last time when I was talking about this, I did not even specify some of these issues on that, because actually we are looking at this in terms of the efficiency of the market. So if I ask you to say that the market is efficient, information has to reach everyone. You have to know. Whether someone is in Geneva, someone is in Isani, he has to know the information. And then through this public means or through the private means. That is very, very strong. So that is the efficiency of the market. Huh? Now you can put it in your weight. You can put it in your weight, right? You can look at. But what I will ask from you, if you are putting it, please, if you have to put this word about my stocks. Yeah. You don't tell me my markets where you buy and sell fish. Right? Here what we are looking at is securities, stocks. Right? Remember we are defined bonds, right? What is a bond, by the way? What is the difference between a bond and the stocks? You know about bonds? What are the bonds? The bonds they do carry the value of money. A bond is more or less like an agreement, but they carry the value of money. More like if you go, you can find this is the bond. A bond, it has the same. It's more or less like an agreement, money, but it takes the value of money. It's a bond. More or less like money, but it's a bond. A bond. It's more or less like agree that you pay the sum. That's a bond. It's more or less an agreement, but it's in form of money. The way it has the face of the what it has got to the money, the same face like that money becomes a bond. While stocks, we are looking at the equity stocks. You know about equity stocks, we are looking at these shares, right? Ordinary shares. They are equity because each one you can access them, right? They are referred to as equity shares. We have called the equity shares, right? And those are that. And again, I actually talked about the debenture, right? Debenture, right? What is the debenture? What is a debenture? What is a debenture? Debenture, assuming a debenture. Principal plus what? Plus interest, right? Without involving collateral. No collateral. You promise to pay the interest, principal and interest, without collateral involved. Right? Debenture, right? I actually gave you an example. There was a talk about this thing, like the debentures. Actually, I told you an example that there are other times in my bank, they just said, we have studied your historical payment to us, and we are impressed. So you are entitled to get a loan, sign a loan. How much do you want? Sometimes we can you just, why not you take 2 million? Why not you take 3 million? Right? Without collateral, what? Without showing them a house. That is what is called in debenture. When you are paying back, you pay back the principal plus the what? The interest without collateral. So with the answer that you have got a house in all, you just have to pay the principal plus the interest, and that becomes the debenture. Some of these things people do by space, especially in the exam. For you to understand, if you look at the question that I asked, for you to say, what is this? Right? What is this? Right? Like my derivatives. Derivatives, they are simple things. Because when I buy a derivative, you promise to pay in future. I will pay you in future a derivative. You can pay it instant, the spot one. Those are what the derivatives. You agree, I want your, Serena, I want your car. Payment, I will pay now. I will take a car. But we have this an agreement that I need your car, and then because I will pay today, you can give me the car. You can give me the car, I can be driving it. That is, they are on the spot. They are on the spot derivatives. Sometimes they are future derivatives, right? You agree, you pay me in future, but you take the thing you give me the person. You can give me the car, I'll pay you next year. I can be using it, and you can change everything, the ownership, whatever, everything will change. But I'll pay you next year. You give me all the type of the blue book. That is what is called future derivatives. They are future derivatives. You promise to pay in the future, but you are using the thing now. Can you accept that?
Yeah.
It depends. It depends who you are doing that deal. If it's a crook. But now, because those are legally binding. They are legally binding issues. Because when you are doing that, I get your car and I'll pay you in the future. I'll pay you in the future. There must be legal aspect. Eh? Can you do that without legally binding, without involving my lawyers? You have to involve the lawyers. I says he wants this, then I will give him. Says I will. There are other people, even especially we talk about the futures. It's mostly in government. It's when they do that. In government, will pay you in the future. Deliver. You can bring kayaweza food stuffs, mabodi, nyemba, chimanga, right? Leave. Will pay you next month or once funding is available. That's what they say. I'm lost in the government. Will pay you once funding is available. Right? That is what is called my future. Pay me in my future. Right? On the spot, you pay it on the what? Spot. That's what is spot derivatives. So you can see, they are again have got it forward derivatives.
Then also say some phone.
I busy about something. So the last one we have got the future. So right, it's what? All right. I think what we'll do is can you please whatever I have spoken, try as much as possible when you are home. At least more fire. You go more fire.
Yes.
Yeah, the more fire you can buy just more fire, and you can just Google and find out what must swaps derivatives efficiency market, what is it? And you can either add it to what you have. I think that can make sense. I think for today, let's stop there.
Wow.
I'm not about my point. Last time I did not explain it to what I've done today. Then so it was like so I'm afraid now I is the question like that. This is not a hypothesis. Right? So you can switch off your gadgets here. Mbona hizo nilikuwa moja kwa Tanzania the call. Sizaje wao je, sizaje wao mbona mimi? Investizo. The call. Yeah, just stop.